If you're not a regular investor, throwing $1,000 into the stock market can feel like jumping in with the sharks. Welcome to the Fifth Beast Production channel. I am not a financial advisor, and please do your own due diligence when investing. Unlike with a savings account, every dollar isn't guaranteed to be there in a few months or even a week. But staying out of the stock market poses an even bigger risk to the prospect of building wealth. Firstly, algorithm-based portfolio can be beneficial if choosing individual investments to build your own portfolio doesn't appeal to you. So-called robo-advisors is a great option for a hands-off strategy. These use computer-based algorithms to design personalized portfolios for investors based on their goals, time horizon, risk tolerance, and other investing preferences. Instead of picking out index funds or exchange-traded funds on your own, you'll get a portfolio made up of multiple funds, increasing your diversification and minimizing overall risk. The second way to invest $1,000 are in index funds. This may sound intimidating, but they're really just a type of mutual fund, an all-in-one investment that diversifies your money across a broad selection of stocks or bonds. Rather than choosing and buying individual stocks, an investor owns a small piece of every company or asset in a certain financial market. The goal is to match the return of the overall market you're invested in rather than placing bets on singular parts of it. Legendary investor Warren Buffett once said a low-cost index fund is the most sensible equity investment for the great majority of investors. The third method to invest $1,000 is in real estate investment trust. If one wants to get into real estate, investing in a real estate investment trust will provide exposure to the market without the time and cost commitment of buying your own property. Equity rights, the most common type of right, allow investors to pool their money to fund the purchase, development, and management of real estate properties. A right focuses on a specific type of real estate, such as apartment complexes, hospitals, hotels, or malls. The fourth strategy is investing in individual stocks. Stock trading is not child's play. Instead of buying into a fund that includes shares of several companies, you're choosing which specific companies to buy. That leaves the task of diversification up to you, like making sure all your money isn't sitting in one industry. One of the behaviors that experts tend to warn against is timing the market, which is almost unavoidable when you're managing a portfolio of individual stocks. You often have to decide where you think the market is going and speculate how the companies you're invested in will react. Thanks for watching, and I would appreciate a subscribe as it truly helps the channel, especially with all the editing and animation takes a lot of time to create.